Welcome, my name's Jeff Driver, General Manager of Business Development and Investor Relations for Australian Foundation Investment Company. I have with me today Mark Freeman, the CEO, and David Grace, who's a Portfolio Manager for AFIC. So Mark, we've just released our financial results for the half year. Perhaps you'd just like to take us through some of the key financial highlights.
Sure. Thanks, Jeff. I'll run through the details of the result and then pass over to David to talk about the portfolio.
Thanks, Mark.
So the half-year profit was $154 million, up 2.7% on the previous corresponding period's $150 million. The interim dividend declared is 12 cents per share, fully franked, which is an increase from 11.5 cents per share from the corresponding period last year. Increasing the interim dividend is in line with our long-term objective of seeking to equalise the quantum of the interim and final dividends over time. The management expense ratio remains very low at 0.15% with no additional costs. AFIC's portfolio was $10.4 billion at the end of December. I'll pass over to David.
Okay, David, so portfolio performance for the year, or the 6 months and the year. Perhaps you could just run through that, and also what were the key sort of drivers for that performance?
Yeah, thanks, Jeff. So pleasingly, the portfolio outperformed the ASX 200 over the last 12 months. So the portfolio delivered a return of 13.2% versus the benchmark of 12.7%. And just a reminder, those numbers are grossed up for franking, and the portfolio performance is on an after-tax basis. So the biggest drivers of performance were our relative underweight to the resources sector, and we took the view that commodity demand was set to soften from large commodity buyer China, and we saw a lot of commodity producers fall during the last 12 months. And then secondly, a number of large overweights within the portfolio, so stocks like Netwealth, Fisher & Paykel Healthcare, ResMed, JB Hi-Fi and Wesfarmers all had really strong years. I think what's interesting for us is just that two sectors have really driven a large amount of the market's return over the last 12 months, so that's been the banks and information technology. And both those sectors are looking extreme in terms of valuation as we exit 2024.
Okay, thanks, David. So perhaps you might just take us through what were sort of the key changes you made over the last 6 months to the portfolio and the rationale behind some of those changes.
Yeah, so just a reminder, we're long-term investors, so we really seek to hold stocks for an extended period of time and seek to benefit from the power that compounding returns deliver to long-term shareholders. So we're not looking to trade the portfolio aggressively. However, there are times when valuations get to extreme levels. So in recent times, we've been reducing our weighting to the banks quite materially just in the last few months. And also through the period, we reduced our holdings in Reece, Wesfarmers and Macquarie Group. Now, in terms of where that capital's gone, we've added 5 stocks to the portfolio over the last 12 months. So that's been BlueScope, Ampol, Worley Group, Macquarie Technology and also Sigma, and all of those new additions to the portfolio were bought at prices where we feel the market wasn't truly appreciating the medium to long-term opportunity in all those companies.
And perhaps you just might take us, Sigma's an unusual one for AFIC, perhaps take us through the rationale behind that.
Yeah, so Sigma's going through the process at the moment of merging with Chemist Warehouse, and we see Chemist Warehouse being a category killer in terms of the pharmacy space. So they are the wholesaler into that retail store network, and we see quite a long opportunity to continue to roll out new stores within the Australian market, but also to expand overseas over the medium to long term. So really a long-term opportunity for earnings growth to come through over many years.
All right, thanks, David. So I guess the question is about what the next 6 months may hold for the market. I know we don't sort of look at macro sort of trends in a sense, but what are you looking at in terms of what you think may happen over the next 6 months, and particularly how you might position the portfolio around that? So I'll start with you, Mark.
Yeah, sure. So we still think valuations look elevated to us. When we look back through history of the price to sales or price to book, both here in Australia and in the US, they're elevated, but the US market has produced much better profit growth out of their markets than they have out of Australia. So I guess we're still cautious. We're still pretty close to fully invested. That's really our style. But in terms of putting new stocks, I think we would be quite selective. As per usual, there's a lot of uncertainty out there in the world, so we're just got to be careful about what we invest in and where we allocate our money at this point.
And Dave, we're very much a bottom-up investment approach that we undertake. What are your thoughts in terms of what you're looking for the next 6 months?
Yeah, so similar thoughts to Mark, with the valuation being pretty full in terms of the overall market. When you step back and have a look at the drivers of the market in the next 12 months, there's a lot going on the macro front, geopolitical front, and even earnings starting to slow with slowing economic growth in most developed markets. Now, none of those scenarios can be predicted with any degree of confidence, so the way that we're managing that is to keep a broad exposure within the portfolio and really focus on quality companies. So looking for businesses that can continue to grow earnings over the medium to long term. And in times like this, it may take a number of years for that to materialise into share prices, but we're comfortable with that as long as we're in quality businesses that are really well managed. And importantly, maintaining strong balance sheets, we feel will be well positioned going forward.
Okay, well thanks Mark and thanks David for your time.
Thank you.
Thanks, Jeff.